G'day guys, and welcome to another cracking edition of Investing in the US, an Aussie's guide to US real estate. The number one podcast geared towards helping investors and real estate entrepreneurs break into the US market. From Los Angeles, I'm your host, Reed Goosens. Good as always to have you with us on the show. Now remember, if you do like this show, you can jump on iTunes and leave the show a 5-star review. It is quick, it is simple, and it shows iTunes we are creating a massive community of eager investors who want to start investing here in the United States. You can also follow me on Facebook and Twitter by searching Reed Goosens. Today on the show, I have the pleasure of speaking with the dangerous duo brothers Tom and Tim Black. Tom, aka Dr. Black, is board certified in emergency medicine. Prior to medical school, he worked for Wells Fargo Financial, overseeing residential mortgage loans. Tom is an active blogger in the healthcare community and passionate about translating high income earners to high net worth individuals through passive real estate investing. On the other hand, Tim has spent his 30-year career at Six Flags Theme Park and Great Wolf Resorts. Throughout his 30-year span, Tim became well-versed in operations, strategic planning, marketing, sales, revenue management, and real estate development. He is a former chief operating officer for Great Wolf Resorts, which owns and operates over 14 resorts in North America. Tim worked closely with private equity to develop new resorts, maximize revenue through pricing and demand, digital marketing, and implementing new revenue streams. So without further ado, let's get them out here. G'day guys, welcome to the show. How are you doing today?
Good morning, Reed. How are you?
Very well. How are you? Where are you dialing in from today?
I am in the bright, sunny state of Texas, right outside North Fort Worth.
Nice. And yourself, Tim?
Good morning. I was making comment earlier that the Aussie accent is nice this morning. We appreciate this. I am calling in from actually sunny Madison, Wisconsin.
Oh, really?
It's going to be a balmy 81 degrees today, believe it or not.
So you guys live in opposite parts of the country?
We do.
Yeah.
Nice. I've heard a lot about Madison. I really want to get up there. I've heard it's a cool little town, similar to Austin, I've heard, but I don't know if that's correct.
No, you know what? Your statement's absolutely correct. It's many people refer it to as kind of the mini Austin. It's not quite as big, but it's very cool because obviously you have a large university with the University of Wisconsin, and then government is right downtown as well. So yeah, many people feel that it's the same way. So it's a pretty cool little area.
Nice.
Cold as heck for about 140 days a year. Outside that, it's okay.
Nice stuff. So the reason I got you guys on the show today is to talk about a lot of things, but what I want to do before we dive into the nuts and bolts is, can you both elaborate on your backgrounds and what made you have the mind shift change to get involved in real estate investing full time?
Gotcha. Well, I guess I'll take that one first, Timmy. So I was not a stellar high school student, barely graduated, joined the Navy because I couldn't have gone to even a technical university or an online school. So joined the Navy at age 17, saw a bit of the world, made the decision that I needed to get an education. For some reason, I jumped into medicine. It was very difficult, and the perception that medicine and physicians are rich, which is not necessarily the case. Having learned that about a decade later, I was satisfied with what I was doing, but I found myself in a profession that seemed to just rely on human capital. I didn't have any assets that I could speak of. I wasn't a business owner. I was basically still a high-paid hourly employee. And so when I finished my residency in Indianapolis, started getting into rental houses and things, and right about that time, it was the downturn in the market, 2008, 2007. So I started buying foreclosure homes. We bought about 10 or so, did very, very well, and kept them as rentals. And then I really learned the appreciation of tax depreciation. And so once I started doing that, I absolutely got hooked. From there, I started doing a little bit of development with a partner, built an apartment complex from the ground up, did well on that. 1031 exchanged that into some commercial properties, and then decided to up and leave my practice of 20 emergency physicians in a different part of the state and moved to Dallas, basically for real estate. So I knew that there's bigger, better things out there. And once I got into real estate, I was absolutely hooked.
Nice. And Tim?
So my career is actually quite different. I grew up in hospitality and entertainment, and early part of my career, 18 years I spent with Six Flags theme parks, moving primarily through the Midwest, and then on the East Coast, I was park president for 3 or 4 of their parks. And then, about the turn of the millennium, the company was not doing very well. So I decided to move on and had an opportunity to go to Great Wolf Resorts, which has today about 15 or 16 properties throughout the U.S. and North America. Was the chief operating officer there for 12 years. A great experience. When I started with the company, we had 4 properties and spent a lot of time actively developing. The last property that I opened actually is in your backyard, Reed, in Anaheim, about a half a mile down from Disney. And then I retired about a week after, and took about 6 months off. And, one thing that, I'd always admired about Tom was kind of his fortitude and focusing on real estate and learning about real estate and being super passionate about it. So obviously I was very young to retire and was thinking about what I wanted to do. Did I want to sit on some public boards? Did I want to consult, which everybody does? And neither one of those two sounded very appealing, especially after 32 years in entertainment and hospitality. So Tom and I partnered, and we've had just an incredible ride. This space is uniquely different. It's in many ways very similar to hospitality and hotels because there are rooms. I'm particularly passionate about how this space prices rooms. When you think about demand and pricing and they go hand in hand, this space in multifamily seems to be a little bit in its infancy about how they think about pricing. And, a room today or an apartment today should be different on a Saturday, depending on the time of year and what your traffic is, what demand is. So that's what excites me about this business. And we've done, some fun things so far. And we, again, appreciate you having us on this morning.
No, it's great. It's great to have both of you on, and it sounds like you've got such a diverse background of experience because, coming from a physician yourself, Tom, and being sort of more in the nuts and bolts of it, Tim. So it sounds like you contrast each other quite well. I want to talk a little bit about the investment strategies you guys are focused on. I know you mentioned multifamily, but is that the only investment strategy you're pursuing during this current economic cycle or climate that we're in right now?
Sure. No, I'd say probably right now it's more 75%. With the current climate, especially in Texas, as cap rates have been very, very compressed. There's just not a lot of inventory out there for one reason or another, whether you say it's a national kind of thing with millennials, with the age of the population choosing to rent, with the restriction of banking. It's a great question. I think that you have to be really diligent about the communities you're looking at and what you're buying.
Right.
What's today is not necessarily going to be tomorrow. The other things we are looking at, we actually just closed last month on a commercial asset, some triple net leased industrial buildings. We've got about 5 of those in our portfolio. They do very, very well. And actually, as of about 2 weeks ago, we're starting to meld in some of Tiv's experience from hospitality, and we're looking into limited and select service hotels too. Very, very similar, as you said. It's just it's renting a room essentially. It's just the operations is the limiting factor and the barrier to entry to get into that business. Unlike multifamily, we have third party management. It's just a little bit more difficult. So we definitely like that, and we're pursuing it. We've got some goals going into 2018 as bringing some of those assets into the portfolio as well.
No, interesting. And so, Tim, you'd be bringing in that experience, right, with the select service. What sort of select service hotels are you looking at in terms of flags?
Marriott has a lot of great brands when you think of limited select service. So does Starwood. So we're looking at both those. That segment has obviously grown significantly since 2008. So we're going to be very selective about the markets that we're in. Obviously, we like demand generators, whether it be, the airport as a demand generator or corporate business parks area, as demand generators. But we think there's a really nice opportunity to blend kind of my experience and my background and be able to return, the kind of investment returns that our investors kind of come to desire.
100%. And it's a little bit interesting. I haven't spoken a lot or at great length about hotel investing, and we'll probably dive into that in a little bit. But Why, in general, do you guys like the commercial side of real estate investing compared to, say, single family? Like you talked about, you're in commercials, triple net lease, you're in multifamily, you start looking at hotels. Why is that? Why did you make that change from single families into multis or commercials?
For me, really, it was basically three things. It's economies of scale, number one.
Right.
Number two, it's the same work. For me to go out and find a 1,500 square foot or 1,000 square foot house, to do light rehab on it to get a tenant, it's the same as me going out and finding a 300 unit apartment complex for the most part. And then third thing is the tax evaluation. If you can return the same amount of risk, and oddly enough, most people that are well versed in real estate would say that. And I agree. I would say that a single family home is actually more risk to me than a large 300 unit community. In that you have a non-recourse loan, and the bank is actually your partner. I mean, the bank has no interest whatsoever into you doing poorly on the asset. So I think there's a lot more of a partnership mentality versus you owning a single family home and having a renter in there. It's just much more advantageous, and I think it's scalable much, much quicker.
Right. And yourself, Tim?
Yeah, I mean, I would agree. It's the multiple. When you think about all under one roof, multiple opportunities to rent individual apartments, or in my case, hospitality rooms. I mean, you just get that multiple on it, and obviously puts the investment in a much, much better place. But I think Tom absolutely hit it on the head.
Yes, sweet. And so, guys, given where we are in the real estate, climate today, and you and I, we've talked a little bit offline about how hard it is to find deals, particularly in Dallas-Fort Worth. What specific markets are you looking at right now, given the types of different asset classes you're starting to dip your toe in outside of multifamily?
Right. Right now, we've moved into probably the last 6 to 8 months. We've looked in the Atlanta market. Seems strong. A lot of good infrastructure things going on, a lot of corporate entities. We tend to like the southern, kind of southeastern states, just because they're a little more landlord friendly than the north. It's really where I feel more comfortable. When you look at maintenance, things like that, and we need to figure. Tim's got a couple of places up in Madison. I mean, things like snow removal and all these kind of things that I don't like to put in my budget. I like something sunny. The other area we're looking at, there's some places in North Carolina we're really, really interested in. But what we're concentrating on is to take two markets essentially and really dive in and dissect them rather than being segmented all around and just chasing the dollar. I really want to get to know the markets and the submarkets. And that's what we've chosen to do in the two markets we're going after. Like you said, in Dallas, it's just gotten to the point where it's hard to be bidding against 12, 20 people and then going to best and final with another 10. It's just gotten so ridiculous unless you've got the inside track. Some people do, that's great, but it's much harder, and more time spent for the deal.
True. And so Atlanta, what was the other in the North Carolinas, right, Tim?
Yeah. So, we like Charlotte a lot. We're starting to think, about that market. We've done, I think, a really good job in Atlanta finding the right partners now. That market certainly seems like it has a bit of runway left. It does feel like it's 18 to 24 months behind Dallas in terms of kind of its economic growth. It's becoming a significant transportation corridor. And I don't know if that's because Memphis is being outgrown when you think of, FedEx and UPS and Louisville. But, Atlanta, when you look at the Southeast, obviously with the airport, is becoming a major player in transportation. And there seems to be a fair amount of job growth in that area. We're going to cultivate Indianapolis. We're actually planning a trip there in July. We like that market. Obviously, it's not in your top 25 markets, but when you think about the opportunity and what's happening in Indianapolis, they're kind of like the silent killer. They're growing responsibly, slowly, but we think there could be a really great opportunity to get in there and find something at the right cap rates that might be a little bit longer hold for us, but that will provide great investment returns.
And you struck on a bit of a point there, talking about hold times. How are you currently underwriting your deals, given where we are? People are sort of doom and gloom that something's coming around the corner. No one knows what. So are you projecting 5 years, 7 years, 10 years? What are you sort of doing in your modeling right now?
We always start with a 5-year projection. I always think of things in terms of 5-year bunches.
Sure.
Right? I want to underwrite, look at the deal at 5 to see what it looks like, but then know with your terms of your loan that you're looking at 10 or 12.
Mm-hmm.
Hopefully in a decade we can turn the economy around if it was. Who knows? But at that, I'm willing to take that risk. I mean, if you look at inflation and what we know is going to happen, borrowing $1 million today is going to be paying back $800,000 tomorrow. I'm sure. It's just that it's the way money works. So you've got some risk mitigation whenever you look at a longer term. But with Dallas, you can't underwrite something thinking that at 18 months you're going to turn around and double your investor's profit, which has been kind of the standard right now. Mm-hmm. It's been unbelievable. Even we're getting ready to go to market with a couple of properties, and 19 months on the market, they've more than doubled, and that's just. People think that that's normal. It's not. It's unfortunate because you're doing very well for their investors, but they expect that that lightning is going to strike twice in the same place, and that's not the case. So.
Yeah, and that economy is only in one place in the United States today, and that's Dallas, right? I mean, it's arguably the most electric economy, and the danger is, to Tom's point, is that we do have some investors that think that that's normal, typical. Mm-hmm. Certainly, we try to temper that.
As they say, you under promise and overachieve, and it sounds like you guys.
Right. Yeah. Overachieving is a great thing, but sometimes it's got its perils.
You got to reel them back from the edge and say, "Come on, guys, we can't keep going after these risky deals."
Indeed.
So, guys, I wanted to start off and dive in a little bit more on the nuts and bolts of today's show, which is understanding the revenue management and the taxation management, and why you both have such a passion for it. So from a high level point of view, let's talk about revenue management for a little bit. People out there listening to the show, what is revenue management? Isn't it just gets rents and, look at operating expenses and we're done, right?
Yeah. In a simplified form, I suppose
I'm joking.
That's probably what it is. But listen, it's all science and data. I mean, when you think about all the data that's out there that we potentially can put our fingers in, and we're not right now. I always like to think about it when people explain it to me or ask me that question is, let's say that we've got a property, and let's just take, Fort Worth, for example. And we know who our customer is. Obviously, we've got a lot of history and data behind who our customer is. But, when you think about the day of week and the week of the year, mm-hmm. and weather patterns play a lot into, when people are coming in the front door to the leasing office, the time of day, the day of week, the time of year, weather patterns play a tremendous aspect on, what kind of demand is being created for that hour and that day. And it's all science behind it. It's nothing more than really what airlines have done, right? I mean, they're probably the leader in this space when you think about how they know, who you are on the other end of that computer and when you're buying a seat and your habits. And, there's really probably two big players in the multifamily space. Rainmaker probably being the one that I'm most familiar with, that have really started to dabble in it. And, they know the customer exceptionally well. Now, it takes a lot of time to pull in that data and all that analytics to be able to, grab, I'm trying to think of how to, say it the easiest way, but to be able to use that data to price rooms effectively. This space, what's interesting to me is it's only as good as the human on the other end of the phone in the leasing office. So right now we depend on, a survey being done where somebody picks up the phone and they're asking, what's your 2-bedroom, 2-bathroom unit cost today, and they're telling them, and that's the data that we have. So right. It's an interesting space, that's for sure. And then when you think about amenity revenue management, whether it's covered parking or laundry facilities or designated parking spots, I mean, there are some real opportunities, I think, to think about it differently.
So just rewinding back a couple of 30 seconds to what you said about the data aspect of it. And I think that's really critical in today's world. It's 2017, and multifamily to a larger extent, you hit it on the head. You're just doing a few cold calls and saying, what are you renting a 2-bedroom for? Do you have any pet fees? And that's sort of the data. But dive a little bit further into it. How are you applying that? It sounds like you've got a lot of experience in it, that revenue management to your actual properties today to make sure that, you're buying a property in the certain time of the year. Obviously, I think I know where I'm going with this question, is that, you're buying maybe in sort of the spring months to be ready for the summer. So you have the maximum, renters coming through the door to try and get, your property filled, if that's the, investment strategy.
Yeah, we haven't given that a lot of thought about yet, but you bring up a really, really great point that, when we're acquiring properties, we haven't given it that kind of thought. I mean, this space, at least our experience has been very challenging to acquire properties, and we have more equity than we have deals right now. Right?
Hey, that's a good thing to have, man.
It's a good thing, and it's a horrible thing to have. So, I wish, and maybe someday, right? I mean, I think you alluded to the point that, there's probably something coming, whether it's a market correction or some sort of bubble, that, we'll be able to think about it a little bit differently. But, when we do look at market comps and market rent, and we obviously look for properties that, are underperforming in terms of, what they're charging per square foot, and look for those opportunities. But, I think that this space, once we get a good base of properties under our belt, we'll probably really start to think about how we price them a little bit differently, versus maybe what our comp set is.
Yep. Interesting. And to your point earlier, you were it sounds like you're trying to draw a similarity between resorts or hotels and multifamily. And you're talking about days of the week, weeks of the year. How do you price that into a rent per square foot, given that you may be doing 6 or 12-month leases?
Yeah, that's a great question, because obviously, the hotel industry is much different, where you're renting for 2 or 3 nights, right?
ADR, right? Average daily rate.
Yeah, well, look at you. Yeah. Maybe you should be a partner with us.
Right.
Interesting question. And I haven't, that's an area that we have to study, that I think as I've spoken to some of the people that I've worked with in the past, that's the one question that they've had is, when you think about 6 to 12 months leases, how do you price that in? But I think it always goes back to, when they're signing that lease, right?
Sure.
A friend of mine just rented a really nice apartment in Seattle, and he called me, and he went in on a Tuesday at about 3 p.m. and looked at it, shopped it, went to another property, and then came back on Saturday, and the price was $75 more.
Wow.
And he was really shocked at what it was. And I said, well, that's revenue management, because you were in there on Tuesday at 3 when nobody's going in, right? And first of all, it's a Tuesday. Secondly, it's at 3 o'clock, and then he chooses to go back at Saturday at 3 p.m. or noon, and ultimately he ended up renting it because he felt the squeeze and thought that he was going to go back, right, and it was going to be even higher. Right. So what they knew about him is probably more and frightening than he probably wants them to know.
That's so interesting. And I guess you'd have to have your on-site property management really keyed into that sort of stuff, right? And setting the bar at a certain level to say, look, guys, people are coming in shopping this throughout the week. We'll have it at X price. If they do start coming on weekends, let's bump it up a little bit, right? There's that saying about, the reasons everyone wanted a certain, widget is because they all arrived at the same time. You schedule them to come to see the property at the same time, and they're competing against each other. And it's human nature to say, well, I want this, and I'm going to pay $75 more than what you're going to pay for it, right?
Yeah, it's the old adage, you have to trust the data, mm-hmm, right? Anything can be overrode. And I think that, one of the things that I learned is that each property that we had a revenue manager. And, I remember many times in my career at Great Wolf where, we'd be going into March and we'd be down versus prior year and asking all those questions. And the revenue management team would always say, trust the data, trust the data. And it's so cyclical that you just have to sit back and, it feels like you're playing roulette a little bit in Vegas. But you do have to trust the data and believe that, what's out there is actually true and factual. But, this space, we're going to need to, think about, with the leasing team, somebody in the office will have to have a revenue management background to some degree and understand data, because it is all science. Right. No question about it.
That's so interesting. Yeah. Tom, you've been a bit quiet over there, mate. Let's get into your passionate thing, taxation management, right?
He's got a passion for revenue management. I'm like, as soon as we grow and we have our own management team,
yep.
we're not that far off. Maybe.
It sounds like it, boys. It sounds like it. Just a quick little segue. I met a developer from in the hotel space from Seattle who was building a multifamily purely for Airbnb, but his backup plan to get financing on it was to be market rent long-term leases, right?
Wow.
So it came down to the financing tract of it that was going to be hard to get the financing on it. But I digress. But it was an interesting model because he could lean back and say, well, look, I'm just going to rent it for 6 or 12 months, right? So
wow.
Anyway,
and probably in Seattle that would work.
Yeah,
right.
Would.
In a tier 1 market, class A property, high class amenities. Yeah, for sure. 100%.
Totally.
So Tom, talk to me about the taxation part of it. And I know you're a massive blogger.
And this is where the podcast takes a dramatic turn. Let's all talk taxes.
Hey, man, taxes. When you're making a decent living, though, taxes are a bitch.
Yes, I could imagine. No, hey, keep it coming. I love it. I'm a foul mouth Australian.
So when I knew getting out that my income was going to go from, I was working 110, 120 hours a week in residency, pulling down about 35G, something crazy good like that.
Mm-hmm.
And, I got out thinking, wow, if when I go into making a higher level income, what are my taxes really going to be? And it was a little bit scary because I went into a 40% tax bracket.
Wow.
And it's a little sobering. It's nice to have those checks, but at the same time, when you saw, 6-figure incomes or so going out the window every year, and that's okay. I didn't ever mind paying my fair share, but when you saw other business owners, things like that had the abilities to grow their business and offset their income, it was very sobering. And so, being able to write off a $200 stethoscope and $100 in scrubs every year wasn't really quite palatable. So
quite cutting it, right?
Yeah, that's originally why I got into it. And so on all our properties now, we always do a cost segregation. We have a third-party engineer come in and take care of that. And that way we're able to redistribute all the pro rata depreciation, whether that's active or passive on the property. And that's one of the things physicians, the lots and a lot of the other professional folks, because we tend to be independent contractors and or a W-2 employee in a 40% tax bracket, it alleviates some of that heartache to doing that. So
yeah. Interesting. And you talk about cost segregation. Talked a little bit about that on this show.
Yeah.
When do you like to implement your cost segregation on say a 5-year hold, right?
Sure.
Are you doing it after you've done your massive reposition? Where on the timeline do you like to slot it in?
If we know it's going to be a longer hold property, a 5-year at least or more, then I usually do it right away because I want to capture all that CapEx, because that first year depreciation is going to be great. I mean, That's a thing. I would rather delay taxes now and then and pay the penalty later when we've got a larger upside. And we can do that. So if we're doing, for example, we've got a nice little property in downtown Fort Worth in the cultural district that our planned hold was going to be 2 years at most. I didn't even bother because you're going to have to pay the piper at some point.
Mm-hmm.
And paying for a cost seg on those wasn't going to be worth it because we're going to be recapturing that and so quickly anyways. So it just tends to work really well to educate and then to have other avenues. My wife, for example, is a realtor. Well, I wouldn't say realtor. Let me say she's got a real estate license. How about that?
Right.
Just to get, if you're familiar with the tax laws about being a professional, it's either recorded 750 hours a year or you're actively involved and you're licensed in the arena that you're working in. So it works very good from a team aspect, her and I, and that it allows us to get maximum penetration for our tax benefits. Nice
stuff. Are there any sort of other ways out there? Because we talk about taxation as, either cost segregation, depreciation, being a full-time, being full-time in the space. Are there any other sort of tidbits out that you can give to the listeners that maybe not have thought about a certain type of taxation that may help them?
Sure. I think the one big thing, and this depends on if you're a passive investor versus you're actively involved. We've looked quite a bit at defined benefit plans.
Mm-hmm.
And obviously as you increase in age, that you can drastically increase your taxability or your non-taxability with IRA contributions, things like that, upwards of $150,000 a year. I'm not sure the exact tiers, but there's another little hidden gem there. It just matters of what your cash flow is and where your risk is for how much cash you want to put away that year.
Right. Nice. And I also, I say a lot on this show that the real estate investing is the only investment in the world that you can have the four ways of making money: cash flow, appreciation, amortization, and the taxation. And, the government isn't in the business of owning real estate, right? They won't even give you, that you can't even get a loan on for your stock investors, but you can get a loan and you can get your interest payments as a tax to depreciation. Show me another investment that does that. So it's an incredible vehicle, and it sort of segues into the education part of it, Tom, because I know you're an active blogger. You're coming from the medical field. Why are physicians so hell bent on maybe not investing in real estate, and how are you trying to change that?
Sure. Well, I actually wrote a book on this very topic that came out last month, or I guess March. So we did very well on Amazon. We were number one in real estate and the investing space for a while. So I think the biggest reason is we get so focused. I mean, most of us have spent 4 years of undergrad, 4 years of medical school, anywhere from 3 to 8 years in residency. You become so dependent and being, I would say, objective, and you're really trained to make decisions for yourself and look at the data independently. And although that is a very good thing in real estate, it tends to make you very narrow-minded and only look at medicine.
Smartest person in the room.
What's that?
Smartest person in the room.
Right. Well, they think they are, and I wouldn't say that that's always the case. So yeah, I think that it takes somebody a little bit more open-minded to look at all aspects and actually trust. Physicians as a whole aren't the most trusting people because that's the way we were trained. Mm-hmm. We were trained to look at the data and be very staunch and trust what you're thinking. And so I think that's the large majority of it. I think as the tide changes, especially with as medicine has matured and the old school thoughts, from the 70s, 80s, and 90s, where medicine was still very gruff, things have changed dramatically in medicine, even over the last decade. And what you're seeing is the people that are getting into it tend to be a little bit more corporate minded, a little bit more W-2 driven, rather than being an independent contractor. And so you're seeing less of it, and they're really more willing to look at alternative investments, which is a good thing.
Right. And it's so funny that it's considered an alternative investment, right? Real estate. And it just blows my mind that we're spoon-fed to the stocks, and we've got to invest in stocks even through through university and high school. It's right. Stock. Let's give it to a broker who's going to apparently
take your money, right?
Let's do that. They're being really successful being a broker, right? They take their 1 or 2%. So it's very, very interesting. Talk to me a little bit about both of you, that the transition into raising capital. Like obviously, Tom, you wrote a book, and Tim, you've come from a very much a high net worth. You've worked with private equity in the past. How did that change when you went to do your own deals to start raising capital and become that key person of influence about real estate investing? And I'll let you go first, but I know you've got to change people's mindsets, right? Like this is what I'm doing, particularly for you, Tom, being a physician, to go into real estate investing. That's like completely 180. For you, Tim, it's a little bit more of a natural progression, I would imagine, going from COO to owning your own real estate investing firm. But there still has to be a transition there, right? And people still have to trust you. So talk to me a little bit about how that worked. Was there any stumbling blocks or anything like that?
Yeah, Tim's actually more in the thick of this than I am. I will say, he's been doing this, about a little over a year now. I would say that because I started about a decade ago or so, people were seeing what I was doing without raising capital. Mm-hmm. I was doing it on my own back until I left my practice a number of years ago and then went to that next level. So I had built up a certain level of not trust isn't the right word, but I guess a reputation that I was doing these things. So it was a little easier for me to parlay that. And I did start the foundation of numerous of my acquisitions and syndications came from those people. So it was a little bit easier for me to launch into it. And I'll let Tim kind of explain, because it's been easier for me, truthfully, than it probably has been for Tim.
Interesting.
Yeah, no, great segue. So, all the people that I've been talking to know me as Tim, the theme park guy, or Tim as the hotelier.
Yep.
And, to see me make this change, one thing I've learned, and we talk a lot about it, is that integrity and your ethics are obviously significant, right? And it's one thing that we underscore with everything we do is that the investor is always first. I mean, Tom and I and Abel, I should probably give a little shout out to Abel, who's another partner in our firm, who's our CPA. He's the guy that, cranks through the numbers. But, we put our investors first in every decision we make. So what's been interesting for me is like, ooh, okay, so, I'm now going out and I'm asking people to invest with us. And that, it does make you pause a minute when you think about somebody who's writing you a check for $50, $75, $100,000, and that the trust that they're placing in your hands. I can't underscore how important that is to understand that, those decisions that we're making every day are the best ones, and that we're always putting the investor first. So it's been an interesting process. As recent as 2 nights ago, I had dinner with another fellow, and he committed that he was going to invest in our Atlanta project. And, that means a lot. I mean, it really does when somebody believes in you. And listen, make no mistake, I've jumped on the back of Tom many times. I mean, I've got books plastered all over my body because it lends immediate credibility, right? When you have MD behind your name, all of a sudden you're the smartest person in the room.
Right. Which isn't the case. Let me just go ahead and say that right now.
No, but listen, I mean, I'm not going to lie here and say that I've jumped on Tom's back and I say, well, I may have done the theme park thing, but here's my brother who wrote a book.
Right.
You want to hold that up? That's a good idea.
Yeah, hold it up. We want to see passive income. Awesome.
So, it does lend credibility. So I have, listen, again, they've only known me for about a year in this space, but it's been an interesting process thus far.
Yeah, no, it's such an interesting, I was a structural engineer for a better part of a decade, trying to transition into, raising capital. It's, you're never not raising capital, right? There's never not enough in my business when I'm starting to get, it's always trying to get the white powder, right? Continually talking with people, out to dinner. I was out last night to dinner, out tonight to dinner. I'm going to a conference on Thursday and Friday here in Huntington Beach. It's just all about networking until you get you create a thought platform, which is obviously your book, Tom, which has been, I think, a great, as you said, Tim, a credibility enhancer, right? It goes to say, look, I know what I'm talking about. Read this book. After you've read it, come and let's have dinner, or we have a coffee, and we can talk a little bit more about the nuts and bolts of what I'm actually doing, because it's a funnel, right? It's all about, this podcast is a funnel. People will listen. They'll listen to you guys. They want to reach out to you. They'll read your book, and they're the little things that you just, okay, I'm starting to change people's mindset about what I'm doing in this space. And it goes back to your point about being credible and trustworthy, because that's the most important thing, to stand on and have your morals to stand on, because you are taking people's money and investing large sums of it in some pretty incredible deals. But back to your point, I think it's really, really important to hit on the fact that, you're confident in the investment that you're searching, right? And you say that you take your investors first. Well, it also comes down to what deals are you chasing, right? And how are you mitigating that risk or the downside to your investors, and, maybe you shoulder the risk a little bit more, non-recourse debt, making sure you've got a massive upside because you know that the in-place rents are so much lower than the market rents. There's different ways you can do it. And I'm sort of going on here a bit, but I really like the point of key person of influence and creating that sphere and changing that mindset, because it's tough. Because out of the two of you, I would have naturally thought, Tim, you would have been the more natural capital raiser, given your background in real estate.
Yeah. Let me put it this way, Reed. What's funny is I have more trouble, or I enjoy more, and I've lost more sleep over raising capital than a gunshot victim in the middle. I mean, I know that sounds horrible, but as far as the mental capacity of knowing and having an algorithmic thing, there's almost more trust in somebody giving you your money, or giving them their money, knowing that, hey, this is everything they've worked for, versus a medical emergency. And the day I realized I was in trouble was where I enjoyed that more. Right. And I knew I was hooked. So,
well, guys, what does the future hold for you two, given all your successes? You've written a book, guys. You've got now starting to raise a bunch of capital. You've got too much capital by the sounds of it. You need to find more deals. So where are you guys headed in 2017 and beyond?
Yeah, so we've developed a business plan, a 5-year plan. That's really important for us to obviously pave the road ahead. We're going to diversify, as Tom mentioned, a little bit more into light commercial industrial. We think that the multifamily, or not multifamily, but hospitality space, limited and select service, has a lot of opportunity. And we're trying to build a brand here. I think it's really important for us to firmly establish and cultivate the roots of Nepali capital. So we've spent a lot of time, starting to build our infrastructure, so that we have a solid foundation, and the piers of our house that we're building are very, very strong. So I think that we're being responsible in the numbers of deals we're trying to get done this year. But we're also at the same time trying to be very ubiquitous, and that's one of the things that we want to say thank you about, is having us on your show, because we're trying to educate our investors, and obviously bring new investors into the pipeline that like what we're doing.
Right. Exactly. Yeah.
Yeah, I would say on that, to grow like an oak rather than grow like a weed. That's the important thing, is doing it right.
Ooh, well said.
It's really
a lot
deep.
of people that jump into a hot market because they think it'll go forever, and that's when you start getting in trouble. And you have to stick to your underwriting, and you have to go essentially just like when we talk about alternative investments, go where everybody's not. That's the key.
I think that's really come to the fore, and particularly in my search this year, is in the last 12 months, and where I'm telling my analysts to go digging up the dirt is definitely not in all these sort of shiny object markets, right? Look at Dallas, Fort Worth. Look at different places. Phoenix, Arizona is another really hot market. Start looking outside where people are comfortable with investing right now. So it's really incredible stuff, guys. At the end of the show, I always ask my listeners and my guests, I should say, to give me their top 5 investing tips. Ready to dive into it?
Yes.
All right. So I know you'd have to have a daily habit. What is it, and how does it help you keep on track towards your goals?
Oh, mine. I would say it's my best habit, my worst habit, and I'm sure it's everybody else's too. It's the dang iPhone. I live and die by that thing. I swear. Emails. I'm one of the big things about Nepali Capital is communication, and I want to be very, very quick, whether it's an investor or anything else. Tim and I and Abel and our executive assistants constantly communicate via text, phone. I mean, it's ridiculous how much we have, almost to a fault.
So that's your daily habit to keep.
So every morning, 6 a.m., I get up, I am on my email, I'm going through, and I probably once an hour check to make sure that I'm not missing something and keeping on top of something. I know that sounds disgusting, but it is a bad habit.
And Reed being on the opposite end of that, it is disgusting. I'm like, dude, it's 6:05. What are you doing? Texting me already.
Hey, gotta get stuff done.
So I think one of the things that I've tried to do is try to maintain a clear head. So I'm really trying to go on a very long walk and hike every day, just to clear my head without my phone, because I think it provides great clarity. I do, and I've tried to think about this a lot. I do my best thinking on an airplane, and I don't know if that's because of all my time flying around the country in Great Wolf, but I've tried to say, what is it about being strapped in a seat where you can't get out of there that's driving me to think my best? Right. And I found that a suitable replacement, just taking a long hike.
Nice. Well, Tom, I'm sure your wife is loving your 6:05 text. Turn the bloody thing off.
Yeah, believe me, she's already looked at me through the door a couple times, giving me the evil eye.
So, guys, who's the most influential person in your career to date?
Tim?
You go ahead, Tom.
So this is horrible, and it's so cliche. I mean, because I was sitting here as we were going through this, thinking about this. I would say Robert and Bob Helms are the two. Bob Helms, just an incredible guy. If you've ever met him, Bob is the father of Robert Helms. Of course, is the Real Estate Guys Radio podcast. I would say Bob and Robert, listening to their podcast, and of course their foundations with Robert Kiyosaki. I mean, the guy just was an outside thinker for years, and has really motivated me in a lot of ways early on. But I'm sure everybody says that, so that's why I'm kind of cliche about it.
Well, not Robert Helm, not the guys. Robert Kiyosaki for sure, but the Helms, no.
Yeah.
So mine's going to be actually quite different. The former Six Flags president, I actually grew up with him very young in my career, a fellow by the name of Gary Story. I worked with Gary for years and years, and he gave me unbelievable opportunity. Unfortunately, he passed away at a very young age due to juvenile diabetes, well early in his life, but really pushed me to do what I thought was absolutely insurmountable things. You know, he would say, I want this done by tomorrow morning. And I was young and stupid and actually put it on my back and did it. And I think I learned a lot from him. And probably the second person would be my brother, to be completely candid with you. Okay, he's looking at me. No, I mean, you know, in many ways, listen, and you know, some people may say it's cliche, but one of the things that I've learned about Tom is, you know, the rest of us run from fear. And I'm one of those people that, you know, tend to look at something and will go the other direction. And Tom actually runs into the fire. He probably should have been a firefighter, where I'd be running away, grabbing a hose. He runs in to save the women and babies. Right. Runs towards fear because it you know, motivates you and in many different ways. But you know, when I think about Tom's career and you know, we're 9 years apart, so which is interesting to think about, that, you know, I was graduating high school when Tom was just getting out of diapers practically. He was
right. I was a late bloomer. I was not getting out of diapers. Thanks.
Right.
I was a little slow. I told you.
Still wetting the bed, right?
Yeah. No. I mean, when I think about his career, and you know, we have an older sister. When I think about his career and being much younger than I am, and certainly, you know, we have an older sister who's 5 years older than I am. When I think about his career and kind of how he thought about it, and you know, he alluded to him being a high school student. I was very similar to him. Was a terrible high school student, and for him to, you know, focus and persevere and get through medical school. Tom has incredible drive, and I think that's really helped me. You know, after the 31 years of being in hospitality and entertainment, that, you know, you feel like you've seen it all and done it all, but this space is new and exciting for me, and I'm learning, which is absolutely extraordinary. And you know, I owe a lot of that to Tom.
Gotcha.
Nice. Guys, pretty touching stuff. I wanted to say congratulations to both of you, because it sounds like you got some incredible people in your careers that have helped you, you know, get to where you are today. So well done. A couple last questions is, what is the most influential tool in your business? And I might already know what yours is, Tom.
Yeah, it looks like Tim either might have dropped off there.
Right, that's okay.
Could have been blowing me a kiss or something. So, you know, the influential tool, there he is. You know, I have to say technology. I mean, my laptop, I sometimes worry about losing it. I mean, I've got my whole life on this thing, and I have to say that there's just, if you could say one person, it's Abel. I would say he's probably our most influential tool. The guy is amazing. I mean, he can translate numbers into opportunity like nobody's business. So actually, he's such a cog in the wheel. I'd have to say him. Okay. The more I think about it.
And yourself, Tim, we're talking about the most influential tool in your real estate business.
Oh boy, yeah. You know, I absolutely think it's probably Abel, no doubt. You know, and I apologize. I'm, you know, jumping on Tom's back on that one, but there's no doubt that Abel is a really, really important part of our team. You know, we filter many deals to him like you do, your analysts, and I think that Abel's helped us to think differently about, you know, looking at the numbers upside down, inside out. So yeah, I would say Abel as well.
Nice stuff. Guys, second last question is, what advice can you give to people out there wanting to get started in the multifamily space today in 2017? What's the number one piece of advice to go out and take some action and get deals done?
Don't procrastinate. I think that's the biggest problem with people, is just waiting for the next deal. When's it going to be better? You know, is it a 7% return or a 10% return? I mean, at the end of the day, it doesn't friggin' matter, right? I mean, it's right. You've got to get off the sidelines and you've got to pony up and at least get in there. Doesn't need to be a lot of money, but it will force you, once you put skin in the game, to learn. And once you have a stake in that equity, you'll be amazed at what happens to you, and the learning you'll just passively absorb because you've got that interest.
Sure.
Yeah, and I think, there's that run towards fear versus, running away from it. I think many people probably would spend a lot of time overanalyzing and saying, well, these are the reasons why I can't do this versus these are the reasons why I should do this. I would also say education. I mean, that's been significant for me. My education curve the last year has been significant. So, the great thing about this space is there's a lot of tools out there and there's a million people to talk to. That's one thing that I've been really surprised to find out is just that, you can pick up the phone and call anybody and they're willing to share their advice.
Sure. Awesome stuff. So guys, where can people reach you? They want to continue this conversation with you guys. You seem very approachable. They want to get your book. Where can they go?
So the book is on Amazon or Barnes & Noble. It is called The Passive Income Physician: Surviving a Career Crisis by Expanding Net Worth. They can go to our website, which is napolicap.com, and that's spelled NAPALICAP.com, as well as I have a blog that I haven't been admittedly keeping up with because we've been quite busy for this deal we have that we're getting ready to hit with Atlanta here in the next couple of days. And that blog is freedomintheblack.com.
Nice.
Yeah, and or they can email either one of us, Tim@Napolicap or Thomas@Napolicap. We're both very quick and nimble, and we respond to all of our emails exceptionally fast, I would say.
6 a.m.
Yeah,
6 a.m. Right.
Well, guys, you've certainly provided some incredible advice. Some of the takeaway pieces of advice that I took away from this interview with protect your downside and know the data. I think they were really two big things coming out of this conversation is know your data for revenue management and taxation management and protect your downside for your investors. They always come first. And I like that we talked a little about with you, Tim, the change in mindset to attracting capital and then putting that capital into a deal, and how that for you, Tom, was more scary and gave you more sleepless nights than someone with a gunshot wound, which is pretty awesome.
I mean, it's
a lot of your listeners aren't going to understand that, but you just got to meet Tom, you'll get it.
Well, guys, thank you so much for dropping by. Enjoy the rest of your week, and we'll catch up soon.
Thank you so much, Reed.
Take care. Thank you.
Thanks, guys.
Bye-bye.